One its standard is IFRS 15 revenue from contract with customers. So here there are actually two parts of this standard. The first part,
Mm-hmm.
the easiest part, is going to be covered in this session, and the second part would be covered only after once we start the FS. Clear?
Okay, clear.
Okay. Just a moment.
It's okay.
Okay, so the standard deals with the income that the company earns. Okay.
Mm-hmm.
So if in the course of activity the company is raising income, that kind of income is called revenue. Okay.
Mm-hmm.
And you must
Okay,
note this doesn't involve a one time transaction. So this is something that happens regularly in the business. Clear?
clear.
Okay. So revenue from contract with customers is likely to be a contract or it's of a kind, okay, where
Mm-hmm.
one party is going to have rights and the other party is going to have the obligation. Clear?
Clear.
So rights is something that the owner receives. The owner receives the right to cash flows or in kind of economic content towards them. Okay. And the
Okay,
customer is obligated to pay them that money. Clear?
clear.
Okay.
Mm-hmm.
And when the obligations are met, or even before the obligations are met, according to the agreement, the owner is going to transfer the goods and services to the customers. Clear?
Clear.
So who's a customer? A customer is contracted with an entity, okay, and
Mm-hmm.
he should be delivered with the agreed goods and services on the agreed time, on the agreed amount, okay.
Mm-hmm.
And this particular goods and services is a normal course of the company's activity. Clear?
Clear.
Okay. And the company doesn't give it for free, it comes with a consideration. Clear now?
Clear.
So, what are the criteria for us to identify this as an IFRS 15? First one, you should identify the contract with the customer.
Mm-hmm.
Okay. And the second is you have to identify what is the performance obligation related with the transaction. So, what
Mm-hmm.
is the company supposed to do? Clear? And
Clear.
the third one is how much price is the company charging for the product? Clear?
Okay,
And
clear.
sometimes the company has a standalone rate, but the company gives at a different rate, right?
Mm-hmm.
And in accounts, as we deal it, we say that nothing comes for free. So even if there is a discount, even if there is an offer, it comes at a cost. Clear?
Clear.
Okay, so it is not free. So
Mm-hmm.
everything that we sell, we have a price for it. Okay. So
Mm-hmm.
sometimes the price that we usually give would be different from the sale that has happened, right? So
Mm-hmm.
what we do at that time is we are going to allocate the transaction price towards the performance obligation. Clear? So
Clear.
whatever sale that we have agreed upon the price, okay, sometimes the services could be rendered or over a period of time. So whatever it is, we are going to allocate the standalone price with the sales that we are going to realize from the customer. Clear? And the
Clear.
fifth one is we're going to record the revenue as and when the performance obligation is met. So that means IFRS 15 clearly tells you you can't record any revenue that you haven't met the performance obligation. Clear?
Yeah, I think I learned that in law.
In FA as
In
well.
law. Okay. So basically, when we only record the revenue until the service has been performed. This
Yes.
is what it means. Okay.
And the general rule or the established rule is if you get any revenue before meeting the performance obligation, then that is considered a liability. Clear?
Clear.
Understood, no?
Yes, understood. It makes
So,
sense.
yeah. So, example ABC Limited, the IFRS 15 is, I think, the video that I have posted on my YouTube channel is 3 or 4 years old, I think. So, I'm likely going to post this online, publish this, okay,
Okay.
for others as well. So ABC Limited is a company. It's just a example, okay? ABC Limited is a company, okay? There's a customer, okay? And ABC Limited has agreed a contract with the customer, okay? So the contract is ABC Limited is going to give the company a car for 2000, okay? And the service is going to be for 2 years and it is going to be free. Clear?
Mm-hmm.
So totally, the company is going to collect 2000 from the from the person that they are selling the car. That is the customer, right? But the car actually has a value of 1800 if we are going to sell it without the discount, without the offers, and the service actually cost 400. Understood? So together with that card, we actually receive 2200. Show how the revenue will be recorded. Okay.
Okay.
So what we do is, okay, so we are going to identify the customer contract first, right? So the
Mm-hmm.
contract is we are giving this one to the customer. So this is the contract. Identification done? Yes. Next is the performance obligation. So the performance obligation is we are delivering a car. With that, we are giving a service for 2 years. Clear?
Clear.
And the transaction price is going to be 2000, right? Now, the
Mm-hmm.
2000 is different from the company's normal pricing. That is a standalone pricing, as we say, that is 2200, right? So we need to
Mm-hmm.
allocate the transaction price towards the performance obligation. Clear? So the
Clear.
standalone price or the standard price is 2000, sorry, 1800, okay, and 400. So together it becomes 2200, right?
Mm-hmm.
Now let's see how much of each of the product falls under the standard price. That means out of 2200, how much percentage is 1800? Same way, out of 2200, how much the service of 400 falls for in percentage. Clear? So
Mm-hmm.
what do we do?
Clear.
So 1800,
1800. Yeah.
okay? So we say this is equal to, sorry. So this is equal to this one divided by this one. Clear?
Mm-hmm.
Okay. Same way, we are just going to drag and drop. Oh God. So equal to this one divided by this one. Right? So 18 percentage. Together it becomes 100 percentage. Clear, no?
Clear.
Now we're going to allocate the transaction. So when we allocate the transaction, what happens? We're going to do it as out of the 2000, that is the total 2000, 82 percentage is going to be the car price. Clear?
Mm-hmm.
Same way, out of the 2000, 18 percentage is going to be the service cost. Clear?
Clear.
Now the twist is this is going to be divided in 2 years' time, right?
Mm-hmm.
Okay. So this is actually under SOPL. How do we record this? We're going to divide 364 by 2 because it's been given for 2 years.
Mm-hmm.
Clear?
Clear.
So it is realized as 182 in the second year and in the first year in 182 and second year 182 again. So if you're going to record the transaction price in the first year, what do? You're going to take it as the car price plus the first year service cost. Clear?
Clear.
So first year you get revenue only up to this much. And in the second year, you get a revenue again for 182. So this is how you are going to realize as and when the performance obligation is met. Understood? So
Yeah, makes sense.
does this because we already received the 2000 amount, right? So
Mm-hmm.
this 182 becomes a deferred income. Clear?
Clear.
Understood, no?
Yes.
Now coming back. So there are different types of IFRS 15 transactions. We're going to discuss some of the most important things that you might be asked in the question. Okay. Can be
Mm-hmm.
in the form of theory, it can be in the form of numericals. Clear? So first
Okay.
is consignment arrangement. Okay. Now you should be very careful with the consignment arrangement because in consignment, we need to make sure in the question what place our company stands in. Okay. So in the
Mm-hmm.
consignment arrangement, there is three stages until the final transfer of the goods. First off is the principal who is going to be the owner or the manufacturer of the product. Clear? And the
Clear.
second is the agent who collects goods from the owner and he sells the goods on behalf of the owner. Clear?
Mm-hmm.
The third is the ultimate customer who consumes the good finally. Understood?
Yes.
So carefully listen. When the goods passes from the principal to the agent, there is no sale that happens. Clear?
Okay.
So whatever amount that is mentioned in the question, it shouldn't be actually recorded because there is no sale. Clear?
Mm-hmm. Clear.
Now, when the agent spots a customer and is going to finally sell the products to the customer, there would be sale. Understood? But
Yes.
here too, you should be careful because in the question, you might be an agent, you might be a principal, right?
Mm-hmm.
So, depending upon where you are from, okay, if you have actually sold the goods off, the sale amount is actually a liability for you if you are an agent. Understood?
Can you please repeat this part?
That is, if you are an agent and you have sold the goods on behalf of principal, whatever
Mm-hmm.
amount that you receive, you might be subjected to only a commission, right?
Yes.
So that commission becomes your sale amount, your revenue. Clear?
As an agent.
Yes.
Okay.
So suppose there is 10,000 goods, right? So
Yes.
you have sold and 10% is your commission. So the remaining 9,000 is a liability that you have to pay back to the principal. Understood?
Yes. Understood.
1,000 would be your revenue in this case.
Mm-hmm.
Okay. The most common scenario is the car dealers. Clear.
Clear.
If Nissan is uh, an automobile that is being marketed here, Nissan is not actually the owner that is present here, right?
Yeah.
Yeah. They're just the dealers. Understood?
Mm-hmm. Yes.
Just a moment. Sorry. Understood this part, right? The car dealers
Yes.
and the manufacturers. They are the most common
Mm-hmm.
example. The second one is the factoring arrangements. Okay.
Mm-hmm.
So there's a company, okay, and the company has receivables. Clear?
Clear.
The company has receivables of 10,000. Okay.
Mm-hmm.
Which would be received only after 3 months. Okay.
Mm-hmm.
But something came up and the company needs the money ASAP. Right.
Okay.
So what the company does is the company is going to sell this goods to, sell this receivables to an outsider company. Understood?
Mm-hmm.
And that particular company is a factor. Okay.
Okay.
Just
Somewhat.
yeah, it's like an inventory, but not an inventory. You're selling your receivables. Understood?
Is it
So,
similar to what we studied in IFRS 9? Or is it something completely different?
no,
It's
it's
like selling
completely different.
debt.
Completely different.
Okay.
Two things.
Completely. Okay. Okay.
Here, what we do is we have a 10,000 receivables from the customer.
Mm-hmm.
Okay. So we can get it in 3 months, right? So
Mm-hmm.
instead of collecting this ourselves, we are actually giving it to somebody else. Okay.
Okay.
And that third party would pay you the 10,000.
Mm-hmm.
Maybe they would give you an advance of 8,300. Clear?
Okay. Clear.
Okay. And this is something that
Yes.
you get early because the customer said they would only pay after 3 months. But you are like
Mm-hmm.
collecting the amount tomorrow itself, right? So that
Okay.
particular arrangement is called factoring arrangement, and the person whom you are selling this receivable is called the factor.
But this is very risky.
Yeah, it's very risky. Now, under factoring itself, that's where this happens. There is two types, recourse factoring and non-recourse factoring. Clear?
Mm-hmm. Clear.
So under recourse factoring, whatever bad debt arises, the company is going to bear it. So the risk is borne by the company. So
Mm-hmm.
under this condition, your receivables is not being sold. Clear?
Mm-hmm.
Hence, whatever amount that you receive is going to be taken as a loan. Understood?
Understood.
Under non-recourse factoring, what happens? Your bad risk is borne by the factor.
Okay.
Okay? Hence, the control and the risk, that is, the risk and the reward is being transferred to the factor itself. So, what are you going to do? You're going to realize it from the receivables. You're going to deduct from the receivables and make it as a cash transaction, and the gain or loss
Mm-hmm.
would be recorded. Clear?
Okay, clear. But I have a question.
Yeah.
Uh, Under what conditions does it lie on the first option and the second option, or it's a choice?
It's a choice.
It's a choice.
Yeah, it depends upon your company what you're choosing actually.
But the second option is much better than the first option.
Yes, maybe in some
Okay,
cases, but
who's
you're
going
very sure.
to
If you're very sure the customer is solid that they're going to pay, then the second option would be, you know, a bit more. That means the non-recourse factoring actually collects a certain fine or fee from you, not a fine, fee.
me? Mm-hmm.
Yeah. So you would get a gain or loss from it.
Okay,
So it depends upon how sure you are to collect the debt. There is
okay.
debt collecting agencies. You might have heard that, right?
No,
No,
it's the
you
first time I see
debt
this
collecting
claim.
agencies are there. That means
Okay,
there are companies who are going to collect debt on your behalf.
okay,
Clear?
clear.
Okay. Third one, sale and repurchase agreement. Okay. So this is
Mhm.
actually your company is dealing in factoring arrangement. So it depends on which recourse factoring or non-recourse
I'll
factoring.
ask
Yeah.
because this is the first time I hear such a
Yeah.
thing.
So if your company is dealing with recourse factoring, then that means it's a secured loan. If your
Mm-hmm.
company is dealing with non-recourse factoring, then it is a sale. Understood?
Understood.
Okay. Now the sale and repurchase agreement. Okay. So
Mm-hmm.
this happens between a company and a bank. Okay.
Okay, okay.
So suppose you have an asset. Okay. And the asset, you're going to sell it to the bank. Let's say the asset cost 10,000. Okay.
Mm-hmm.
And the bank gives you 12,000 for it. Clear?
Okay,
So after 2 years, suppose the deal is there are high chance that you're going to repurchase this particular asset back from the bank. Okay?
okay.
There is high chance. In that
Mm-hmm.
case, we're going to record whatever received as a loan received. Okay?
Mm-hmm.
And the extra 2,000 that you receive from the bank would be as an interest. Clear?
Clear.
Understood?
But if I am selling something to the bank, why is it considered a loan and why is there interest in
Hmm.
the picture?
Because it's there is high chance that you're going to take it back.
Oh, okay,
There is a
repurchase.
repurchasing factor.
Okay, okay.
Understood?
Okay, if I'm repurchasing something, why is there a loan?
Because it is considered as a loan under IFRS 15. Because there is a
Okay,
high chance that you're going to repurchase that, then that means you're not actually completely letting off the asset to the bank, right?
okay.
You're not completely letting off the asset. You're not telling the bank you can do whatever you want with it, right?
Okay, so
Instead,
you're saying
yeah, instead you're
that,
saying, I might come back.
okay,
There can be
and
options as such, options
okay,
that are exercisable.
okay. So the reason why I have to pay interest is because they're holding this asset for me that I might repurchase in the future.
Yeah, because bank is giving you 12,000, right? So 2,000 extra. So that
Mm-hmm.
2,000 would be treated as a 2-year interest. Understood?
Okay.
Now, suppose the repurchase is very low, the chance is very low, then that means it's a sale. And this happens frequently in your business. So it's a
Mm-hmm.
sale. So the asset is taken away, the cash is added, and the difference is taken into gain or loss. Clear?
Mm-hmm. Clear.
Now, IFRS 15 deals just not with the revenue, it deals with different kinds of transaction that comes in form of income in the company.
Mm-hmm.
And it is done under a normal circumstance in the business. Clear? So all the bank
Clear.
transactions, the consignment arrangement, the factoring arrangements, these all happens in a company on a frequent basis.
Mm-hmm.
Clear?
Clear.
Okay. It might not
Mm-hmm.
be, there might not be everything in the company, but some of the elements can be there. That's all. Just
Mm-hmm.
examples. Clear?
Okay. Clear.
Next is bill and hold arrangement. So what is a bill and hold arrangement? Suppose you have purchased a machine from a company. Okay.
Mm-hmm.
And due to some reasons, for some reason, you don't want the company to transport that machine to your company. Okay.
Okay.
So you tell the seller that you hold that machine for a while. I'll tell you when to transport that. Okay. So this is
Okay.
called a bill and hold arrangement. So you have billed it,
Mm-hmm.
but the machine is kept as a kept in holding, right? So the sale
Mm-hmm.
has happened, but the obligation is not fully met, right? So
Yeah.
you here is a third party holding the customer's product onto your warehouse. Understood?
Okay. Understood.
Clear? And the fifth one
Mm-hmm.
is warranty. Okay?
Mm-hmm.
Okay, warranty arrangements, which we have already
Okay.
discussed in IS 37.
Mm-hmm.
Clear?
Clear.
Okay. So that's it. Okay.
Okay.
The IFRS 15 is done. What I want you to do is